Hi everyone. The Wall Street Journal misled us. That's not a joke. That is a fact. For the past few months, the airwaves have been filled with the comforting narrative of a soft landing. You know the story. Inflation has supposedly been tamed, growth remains robust, and the Federal Reserve is standing by, ready to cut rates and save the day. This narrative is so smooth, so seductive, that it has tempted countless people to leverage up and rush back into the market. But as a trader who has been in the trenches of this market for years, I have a responsibility to tap you on the shoulder while the party is loudest. I'm going to show you the underlying data hidden beneath the charts. Once you see it, you'll realize this is actually a carefully orchestrated illusion. While you're watching the indices hit record highs, the foundation is crumbling. Three fatal factors are currently syncing up in a rare and dangerous resonance. 1. Valuations are priced for perfection. There is zero room for error. 2. Liquidity, the lifeblood of the market, is quietly being drained. 3. Shadow leverage, massive debt hidden in unregulated sectors, is amplifying risk in the dark. Don't be fooled by the surface calm. We aren't welcoming the dawn. We are walking into a textbook mean reversion machine, a meat grinder for capital. If you are still holding on to the buy blind and win big fantasy, the market is about to teach you the most expensive lesson of your life. Part 1. The gravity of valuation. When price divorces reality. Right now, there is a massive, undeniable fracture between market prices and economic reality. The market has priced in every possible piece of good news, and it's partying even in the face of obvious macro headwinds. Warren Buffett once called the total market cap to GDP ratio the single best measure of valuation. In the industry, we simply call it the Buffett indicator. Look at history. If this indicator crosses 100%, the market is generally considered overvalued. At the peak of the dot-com bubble in 2000, that era of absolute madness, it hit 140% to 150%. During the liquidity flood of 2021, it touched 190%. Recent data shows this indicator has smashed through both psychological and technical limits, reaching a staggering 218%. This isn't just a number, it's a flashing red siren. Financial markets operate on an iron law called mean reversion. When asset prices deviate from the real economy by more than 2 standard deviations, the correction is rarely gentle. It is violent and nonlinear. Statistically speaking, buying at these levels implies that your expected returns over the next decade will be extremely low, potentially even negative. If the Buffett indicator feels too broad, let's look at Nobel laureate Robert Shiller's metric, the Shiller PE ratio, or CAPE ratio. The S&P 500's Shiller PE has climbed to 37.1x. To put that in perspective, current valuations are 87% above their long-term historical average. This is an extreme outlier. In Finance 101, we learned that investing in stocks requires a risk premium, the extra return you get for taking a risk compared to safe government bonds. But with treasury yields remaining high, the stock market's high multiples mean the equity risk premium has been compressed to almost zero. In plain English, you're taking on massive tail risks, recession, geopolitical conflict, black swan events, and you're getting paid almost nothing for it. It's like swimming in shark-infested waters just to pick up a few loose coins. Part 2. The twilight of big tech and market fragility. Look at the Nasdaq 100. Its PE ratio is approaching 40x. For veteran traders, that number sends a chill down the spine. Why? Because in March 2000, right before the epic dot-com crash, the Nasdaq's PE was exactly 40.1x. This valuation is built on a fragile assumption that corporate earnings will continue to beat expectations forever. At this altitude, the market will not tolerate even a whisper of disappointment. A minor downward revision in guidance will trigger a violent derating or valuation crush. Even more worrying is market breadth. The so-called Magnificent Seven now command a total market cap of $20.9 trillion. These few companies account for 52% of the total US market cap and have driven 80% of this year's gains. This extreme concentration makes the market structure incredibly brittle. Imagine nearly all passive money and momentum hedge funds crowding through the same narrow door. If a liquidity shock hits, these former heroes become the market's ATM. When institutions need cash, they don't sell what they want to sell. They sell what they can sell, the most liquid assets. This leads to a stampede. Part 3. The plumbing is freezing. Many investors watch the nominal money supply, but that's like driving looking in the rearview mirror. In modern finance, you need to watch the plumbing. We aren't just seeing a reduction in total money, we are seeing a freeze in marginal liquidity. Whether you like crypto or not, you cannot ignore Bitcoin. It acts as the canary in the coal mine, a hypersensitive detector of global fiat liquidity. In just the past week, Bitcoin crashed over 22%, erasing its year-to-date gains. This isn't just a crypto issue. Bitcoin often moves ahead of traditional assets. It is telling us that the smart money is retreating. Sentiment is flipping rapidly from extreme greed to fear. This is the high water mark left by the receding tide of global liquidity. Let's look at the professional indicators that actually make Wall Street nervous. 1. SOFR secured overnight financing rate. This spiked to 5.35%. This shows that in the repo market, the heart of the financial system, the supply and demand for cash and collateral is broken. Banks are scrambling for cash. 2. Libor OIS spread. The spread on the 3-month dollar Libor OIS has widened to 38 basis points, a high not seen since the banking turmoil of March 2023. This is a classic signal of distrust. Simply put, banks are becoming afraid to lend to each other. 3. The RRP, reverse repo facility. The Fed's RRP facility was a massive reservoir of excess liquidity. That tank is running dry. The buffer of excess reserves is vanishing. When this buffer is gone, the Fed's quantitative tightening QT will no longer have a shock absorber. It will hit bank reserves directly and then risk assets. Global capital flows. In the past, US assets were buoyed by global dollars flowing back home, specifically from trade surplus nations. But as interest rate expectations shift and global asset allocation rebalances, this flow is reversing. The marginal buyer is disappearing. When the selling starts, we're going to be shocked to discover there's nobody underneath to catch the falling knife. Part 4. Invisible leverage, the Achilles heel. If high valuation is the dry tinder and liquidity tightening is the spark, then invisible leverage is the gasoline. This is the most critical warning in this report. Unlike 2008, the risk isn't on bank balance sheets. It has migrated to the opaque shadow banking system and complex ETFs. By September 2025, US investor margin debt hit a record $1.13 trillion. Margin debt is a pro-cyclical killer. On the way up, it fuels the bubble. On the way down, the dreaded margin call forces forced liquidation, regardless of price. This mechanism causes flash crashes. Furthermore, as traditional banks pulled back due to regulation, the private credit market ballooned to $2.1 trillion. This is a regulatory blind spot. Structural flaws, many of these loans are covenant light or allow payment in kind, PIK. This means borrowers can pay interest with more debt to hide the fact that they are broke. It is essentially a Ponzi finance structure. Signs of default. The bankruptcy of auto parts maker First Brands Group was a thunderclap. It's not an isolated incident. The Boston Fed suggests that if you account for expected losses, real default rates in this sector are already at 5.4%. Valuation illusion. Private credit assets aren't marked to market daily. Their low volatility is fake. Once a liquidity crisis forces funds to sell assets to meet redemptions, the net asset value NAV will fall off a cliff. And let's not forget the mathematical trap of leveraged ETFs. There is over $40 billion sitting in leveraged products on the Nasdaq and S&P. These funds must rebalance daily. If the market drops, they must sell more stock to maintain their leverage ratio. It is mechanical, price-insensitive selling. During a sell-off in October 2025, we monitored leveraged ETFs being forced to dump $26 billion in equities just before the close. This creates a death spiral. Drop dollar, right arrow dollar, forced sell dollar, right arrow dollar, bigger drop. Part 5, echoes in emerging markets. Global liquidity contraction inevitably hits emerging markets. While China has its own economic policy cycle, it cannot be immune to the grand narrative of global capital flows. If you think the storm across the Pacific won't reach Asian shores, you are being naive. While China's Asia market broadly looks like good value, its tech sector, specifically the STAR market, similar to the Nasdaq or ARK Invest style holdings, shows clear bubble characteristics. The STAR market's P/E ratio is a sky-high 247x. This valuation assumes infinite liquidity and guaranteed growth. In a global risk-off mode, high beta, long-duration assets like this are the first to be sold. We are also facing technical selling pressure. Hedge fund deleveraging. Much of the foreign money in these markets is transactional. As US volatility spikes, these funds must cut exposure globally to satisfy risk controls. They will sell Chinese assets not because they're bad, but because they are liquid. Calendar effects. As we approach year-end, we face window dressing and tax loss harvesting. Institutional risk appetite vanishes. With no new money coming in, the market is incredibly fragile to foreign outflows. Part 6. The Investor's Survival Guide. Based on this macro analysis, we are in an intermediate liquidity shock. While policymakers may eventually intervene, trying to bite a dip right now is like trying to catch a falling knife. For institutional investors and high net worth individuals, our advice is clear: shift from return generation to capital preservation. In this environment, cash is environment. Cash isn't just a safe haven, it is a valuable call option with no expiration date. It gives you the right to buy high quality assets at distressed prices later. Overweight cash and short term treasuries. Clear out all margin accounts. When volatility spikes, leverage is fatal. Even if your long term thesis is right, volatility will wipe you out before you get there. Survival is the only objective. Defensive rotation. Reduce exposure to high valuation growth stocks. Move toward low volatility, high dividend, cash-rich value stocks, the defensive blue chips. The financial market is currently unwinding the fantasy of a painless disinflation. However, for the mature investor, this is not the end of the world. It is simply part of the cycle. In fact, this is where opportunity is born. Historically, every great transfer of wealth happens during a crisis. When the crowd is selling quality assets due to fear and margin calls, if you are the one holding cash and patience, you will be the ultimate winner. Keep your liquidity high, wait for the market to clear. After the storm, there will be gold scattered on the ground. The only question is, when the gold is there, will you still have the chips to pick it up? Stay sharp, and good luck.